Are we ready to attack this simulation on inventory adjustments? Yes, we are. So what's our agenda for this video? Well, we're going to start off by doing a quick overview of the simulation, and then for each item that was flagged by the auditor, we're going to identify if there is a potential misstatement, and then we're going to investigate those potential misstatements. We'll ultimately need to conclude on those misstatements, and then at the very end, we're going to aggregate up all of the misstatements and determine whether inventory is materially stated or if there's a material misstatement that does exist. So if you've ever audited, then you're probably familiar with an inventory count. These typically happen on the last day of the fiscal calendar because the company wants to know how much inventory they have on hand as of the last day of the year, because ultimately that will become their inventory balance on their balance sheet. And so what they'll do is they'll attend this physical inventory count, and yes, they'll focus on, does management have good inventory count procedures, but the audit team is also focused on substantively testing the inventory balance. So they'll go ahead and do their own test counts, meaning they'll go out, actually count inventory for a specific item, compare that to what the amount is listed for in the company's perpetual ledger. So the overarching point is that if there is a difference between what is counted in the warehouse and what is counted on the company's inventory perpetual listing, then there's going to have to be an adjustment. Now, just because there's a difference at first doesn't mean that's going to result in an actual adjustment. And that's what this simulation is all about. It's saying, okay, there is a variance. I need you to go investigate why. And that's what makes this simulation difficult, because there's all these different exhibits that we're going to have to read through. And just one of them could have a piece of information that ultimately says, no, there is no adjustment here. This is fine, right? So that's what makes this hard, because we don't know exactly where to stop or what the right answer is, because we could keep going and keep searching for answers. And that's one of the challenges when it comes to auditing. So the first thing we're going to do is evaluate whether an adjustment is required for each of these three product lines that were flagged by the audit team. And then we're also going to have to give a justification for the adjustment required. Right? So what does it mean to go ahead and compare? Well, as we can see in this visual, this is really going to be our first step. And the audit team would do this for every single product line, but we're just going to do it for these three, right? We're going to compare the count per the inventory count sheet, which is what the audit team and the company used to go ahead and count inventory in the warehouse. And then we're going to compare that to the perpetual inventory listing. And we'll come up with a unit difference. Now, ultimately, if there's a difference in units that is substantiated, meaning, okay, based on other review of exhibits, we believe this is a true variance, then we'll go ahead and turn that into a dollar adjustment by multiplying by the unit cost. So that is how we're going to go through for each three of these. And the difficult part is step number 2, which is where we're going to investigate. There's really no rhyme or reason as to what exhibits we're going to need to look through, but we will need to look through them all to make sure there's no information that we are missing. So let's start with our first product line, and that is the widgets, which are 10 millimeter, right? So we're going to start by comparing the inventory count sheet and the perpetual listing. So when we pull up the inventory count sheet, well, we see that it could be in two potential spots, right? There's two warehouses. And we don't know yet which product this is because we need the actual SKU, right? So what we'll do then is pull up the perpetual inventory listing, and we see that the widgets, the 10 millimeter, right, that is SKU 267-1. And according to the perpetual inventory listing, there's 1,000 units. So now that we know the SKU for widgets, the 10 millimeter, it's 267-1, well, we can go back to the count sheet. And for warehouse A, it says there are 131 items counted. And for warehouse B, there was 119 units counted, right? So that sums to 250 units. Well, there's a clear variance between these two sources of information, right? We're off by 750 units. Now, that could be a true variance, or there could be a rationale for it. So this is the tricky part when we move into step 2, and we need to investigate this variance. So the first exhibit we're going to need to reference is actually the email from the controller. So obviously this initially starts out with the audit team asking about returns, but there's also a little blurb in there that says the perpetual inventory listing includes 750 units of SKU 2671 that has been consigned. Right, so consigned inventory is inventory that is not in the company's warehouse. It's actually at the consignee's warehouse. But because it's consigned inventory, the company, they still own that inventory and should be included in their inventory balance unless the consignee actually has sold the units. And so how can we answer that question? Well, when we look through the exhibits, there's actually one that says supplier report. And when we pull that up, they actually talk about SKU 2671. And at the very last bit of this paragraph, it says, as of December 31st, year 4, all consigned goods were sold by the customer. So that means that consigned inventory, it's been sold. And so it should not be on the company's year-end inventory balance, right? So because that was included in the perpetual inventory listing, that is going to be incorrectly stated in our actual inventory count, which says it's 250 units. That's what should be reflected on the company's final inventory listing. So now we need to calculate the adjustment in step 3. So the adjustment in units, right, is 750. And you'll notice it's negative, and that's because we actually need to remove units from the perpetual listing. It's going to be an adjustment that decreases inventory. So that's why it's a negative 750 units. Now, what is the unit price to multiply by? Well, if we go back to the perpetual inventory listing, it says that the latch purchase item cost was $4.99. So that's going to be our figure. And so when we multiply those out, we get negative $3,743. Right? So that's the adjustment. And what's the rationale there? Well, we talked about it. It's because items consigned to customer were actually sold, meaning it should not be on the company's balance sheet because those consigned inventory items, they were sold to the end customer. So now it's completely off both the warehouse for the consignee and the company's balance sheet, right? So for this row, the correct answer is going to be negative 3,743. And for the justification, it's items consigned to customer were sold. The next product line we need to investigate is widgets, and those are 5mm. So this time we're going to pull up the perpetual inventory listing because we know that we need to get the SKU first. According to this listing, right, the SKU is 267-4, and there are 4,102 units on hand. So when we compare that to the inventory count sheet, well, that in warehouse A says 4,098, and in warehouse B, it says it's actually 0. And so what's the variance there? Well, the variance is only 4 units, right? So not a big number, but we still need to investigate it. So this part is tricky, and this is why you should probably read through the exhibits in the beginning so that you know what you could be looking for, right? Or what type of information we're actually providing. And they actually give us a memo that one of the staff auditors wrote to the audit file. So this is not uncommon, meaning they are basically making a note in the audit file. And they say that actually there was a counting error on their part for this SKU. So they actually went back to the warehouse, recounted, and got to 4,102 units for SKU 267-4, right? So they validated that was correct. And so in reality, the auditors made an error in their count. So there is no error here. There is no variance and no adjustment is needed, right? So that happens occasionally, right? The auditors can be wrong. So for this row, the correct answer is actually going to be a $0 adjustment, and the justification for that is error in count. Our last product line to investigate is Hex Bolts. So going back to that perpetual inventory listing, we see that it's SKU 561-3, and according to this listing, they have 9,875 units for this SKU. So per the inventory count sheet in warehouse A, they have 7,975 units, and in warehouse B, they have 1,950. And so this actually results in a variance of 50 units, right? So in the inventory count sheet, we have 9,925 units, but the perpetual inventory listing is saying that there's only 9,875 units. So that means we're actually counting 50 more units than what the listing's saying. So if this variance is actually a true variance, we're gonna have to increase the inventory balance for this amount. So this is where we're gonna have to go investigate now. And the first exhibit we're gonna have to reference is actually the warehouse location listing. This provides us, a map of the warehouse and exactly where each of these products are stored. And we see that for Hex Bolts, well, they're not only in storage location D in warehouse B, but they're also in the returns area, right? That's interesting, right? Meaning customers return this item, so it's now back in the company's possession because they've issued a refund. But was this included in the count, and how is this reflected in the perpetual inventory listing? That's what we need to answer. So if you remember, the first exhibit that we actually opened up was an email from the controller. And the initial subject for that email was returns. So when we bring that up, the audit team actually specifically asked whether returns were included in the count. And the controller said, yes, the counts are correct and returns have been included in the counts. So those hex bolts that were in the returns area, that's included in the inventory count sheet. But is it in the perpetual inventory system? And they say no. Actually, the returns have not yet been processed, but they should be, right? Because they've issued that refund to the customer and that inventory is back in the company's possession. So that means that the perpetual inventory system is understated by 50 units. So we will need to make an adjustment to increase inventory by 50 units. So in step 3, we'll take this adjustment in units and turn it into a dollar adjustment. So we're increasing it by 50 units. The price per unit based on the perpetual inventory system, right, was $12.89. We multiply those two numbers, and that means our inventory adjustment in dollars is $645, right? We round that up to the nearest whole dollar. It's a positive amount since we need to increase inventory. So for that row, the correct answer is going to be a positive 645, and the justification for the adjustment is returns not yet processed in the perpetual inventory system. So that was the first part of the simulation, right? We investigated those variances. We ultimately determined, does an adjustment need to be made? And if so, what was the dollar amount, right? So now looking at it, right, we have $2 adjustments for widgets, the 10 millimeter, and the hex bolts. And this last question asks us, okay, based on that amount, does that result in a material misstatement, right? So individually, we'll need to assess those, and then we'll also need to aggregate them. And looking back at the prompt, our performance materiality is $5,000, right? So that's what we're going to be comparing our total misstatements to determine if there is a misstatement. And remember, it's absolute values, right? So that's either positive or negative, meaning it's overstated or understated in comparison to what actually the amount should be. Now, since performance materiality is 5,000, both of these are under 5,000 on an absolute basis. So individually, there is no material misstatement. However, let's go ahead and add them together. So when we do that, we see that SKU 2671 was negative 3,743. And then for SKU 561-3, it was a positive 645. That means the aggregated misstatement is a negative 3,088. Well, on an absolute basis, that is still below our performance materiality threshold of $5,000. So what's our conclusion? It's that there's no material misstatement. So that means the correct answer for that dropdown is going to be based on the inventory work performed. The inventory balance is not materially misstated because the required adjustments identified are less than performance materiality, right? So that is how we take the variances that we initially identified all the way through. So one thing that is important to understand is that because these are not material misstatements, they would still be included on the summary of uncorrected misstatements, right? Remember that. And the audit team would group these adjustments with all the other misstatements from other financial statement line items and still need to determine, okay, is there any possible way the financial statements are materially misstated, right? So that is how we take this from start to finish. This is a great simulation, not only for inventory adjustments, but just the process of evaluating adjustments and determining, is there a material misstatement, and if so, what is it?